Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
Okay, I'm James Emanuel, and joining me today is JT Fitzgerald, CEO of the US-listed business Kingsway Financial Services, ticker KFS. This may be one of the most exciting companies that most people have never heard of. It has a market capitalization of just shy of $400 million, and it has a very interesting story. It's a new company, and it's not a new company at the same time. Allow me to explain. So founded in 1989 as a niche insurance business, Kingsway thrived for nearly 2 decades. But then came the great financial crisis, and it hit the company hard. It made large losses, which became an existential threat. But these net operating losses are an attractive asset because they can be used to shield future returns from tax. So at that point, in steps Joseph Stilwell, an activist banking investor who wanted to exploit the net operating losses and turn Kingsway into a merchant bank. Insurance operations were shut down, but the merchant bank struggled within a public vehicle. So that turnaround plan clearly wasn't working. And in 2016, JT Fitzgerald, my guest today, entered the stage. He had experienced success with search funds, having launched his own company, Argo Holdings. He had the idea to transform Kingsway into a public listed search fund business. And it took some time to convince the board to dispose of legacy assets and to restructure the business. But ultimately, JT became the CEO, and he has proven that this model not only works, but is the best way to exploit those net operating losses that I mentioned earlier. The first search fund launched within Kingsway delivered a 10 times cash return on investment in just over 4 years, and that was proof of concept. Since then, the company has gone from strength to strength. So without further ado, let me welcome JT.
Thank you, James. Happy to be here. I really appreciate it.
Thank you for joining me. So for the benefit of those that are unfamiliar with search funds, would you explain what the search fund model is?
Yeah, happy to do it. I think in essence, the search fund model is an investment and acquisition strategy whereby historically a group of investors partner with a very talented but perhaps earlier in career entrepreneur to search for and acquire generally small operating businesses, whereby then the entrepreneur, after the acquisition, transitions into the day-to-day management of the acquired company, typically transitioning out the retiring founder.
This is a model which I believe was kind of spawned out of the US business schools, because you had MBA students who were very bright and were very anxious to embark on a career. And you also had a different group of people who were private equity investors. And so you bringing those two together, it was possible to find a mum and pop type shop, which had great potential, where the founder was looking to step down and had no succession plan to speak of. And so in steps the search fund, uses the private equity funding to effectively buy out the existing owners. And then the MBA student steps in as the new CEO and looks to scale up that business and use it as a springboard for better things. Is that a fair way of looking at it?
I think that's right. I think, with one distinction that, the model probably has been around for a long time before it was formally called a search fund. I think that search funds as kind of a defined term really started to come into existence roughly 30 years or so ago. The first few were spawned out of Stanford and then Harvard Business School. And one small distinction is that the equity supporters of this strategy generally have been people that have gone down this path themselves before. It's not private equity in that sense. I think I view it more as what I would describe as craft investing in the old-timey sense of craft, artisan apprentice. And so the folks that are backing today's searchers generally and typically have been themselves searchers and business operators at one point or another in their life.
Got it. Okay, that makes sense. But in the past, it's fair to say, I think, that these search funds were the kind of remit of private investors. They weren't really available for public market investors. And so you saw an opportunity there. You thought that to launch the search fund model within a listed public entity would give you access to a permanent capital vehicle that would be able to grow a diverse portfolio of businesses and benefit from benefit investors because they've got the liquidity of the public market with no lock-in periods. And so everyone comes out smiling. Was that the way you looked at it when you joined Kingsway in 2016?
When I came to Kingsway, the thesis was the attractiveness of the platform as a permanent capital vehicle. If you look at the research on search funds, the return profile has been very good. But if you go even deeper, and there's been some primary research on this, even though the returns have been good in the traditional model, if you look at the returns to the people that then acquired those businesses when the searcher and their investment partners exited, the next 7 to 10-year returns have been just as good, which means that historically, searchers and their investors have been exiting those businesses too soon. And so the idea of having something, a platform where you could own those businesses for a longer period of time and continue to compound capital was very attractive. Okay. Obviously, in a private investment context, there's a natural and maybe in many cases hardwired requirement to generate liquidity. And so finding a vehicle that could eliminate those requirements and allow you to own businesses for a longer period of time was very compelling.
So would you be able to give us just a brief background of your history, kind of academic and career prior to joining Kingsway?
Sure. Prior to business school, I sort of went to business school from a non-traditional background. I was actually a floor trader on the Chicago Board of Trade, trading fixed income futures and options. That world was coming to a fairly abrupt change with the electronification of what was formerly open outcry as a form of price discovery.
I remember it well.
And so I used that sort of disruption as a reason to go back to business school. And in my life, I have a mentor who encouraged me to go to business school and think about pivoting into an operating role, operating, running, becoming an owner of a business. Coincidentally, he had done something out of Harvard Business School in the late 60s that looks very much like what we would call a search fund today. And so I went to business school with the idea of obviously rounding out my education and background, but really trying to bolster it with the idea that ultimately I would want to become an operator and owner of a small company. And while I was in business school, I was in a private equity class, and one of the case studies was on one of the original search funds, which is where I learned about the model. And it was one of those lightning bolt type moments where I learned about something that I thought was impossible, that you could find a group of investors to support an inexperienced person to go out and buy a business and go run it, which was exactly sort of what I was hoping to do maybe several years after business school. And so armed with that, I did a lot of research. It was a pretty small community at the time, reached out to a lot of the current and former searchers and learned about the model, and then went out and raised capital and formed my own search fund in 2002. I think there were probably 5 or 6 of us launching search funds that year. I had a partner, we searched together, and we ultimately acquired a manufacturing business in Lexington, Kentucky. A retiring founder, no succession plan, no sons or daughters in the business, very nice setup. And we acquired that business and ran it for several years. After 6 or 7 years, brought in professional management, elevated to the board role, and we ultimately exited that business in 2016. With some residual sales in 2017. Along the way, many of my original investors had heretofore not had any exposure to search funds. And so they said to me, to the extent that you, JT, find other people that are doing what you're doing, based on some early success, we would love to invest with them too. And so pretty early on, 20 years or so ago, I also became an investor on behalf of my investor group and a little bit of my own personal capital in other people that were launching search funds. And so I've been both an operator and an investor for over 20 years.
Very good. Okay, so at the moment, within Kingsway, you find MBA students who are looking to be owner operators, and then between you launch a search fund, but the vast majority of businesses, estimated I think to be over 99% by number, not by valuation, are small privately owned enterprises, mom and pop type shops. So there are literally hundreds of thousands of these all over America. How do you filter out the wheat from the chaff to find your targets? And what does your search process look like? Do you use brokers or do you participate in auctions?
It's a great question. Yeah, so you're right to point out what we call the silver tsunami. That's not a term we invented, but it's this sort of demographic reality based on the baby boomer generation, where a huge number of privately owned businesses in the U.S., North America, I think probably globally, are owned and were started by and currently run by people who are reaching or have already reached retirement age. And so there's this natural succession problem in North America where we're focused. And so I think that the search fund model is a very uniquely shaped key to solve a problem for a small business owner who wants to monetize their primary asset and retire. And so that's sort of the setup and the context. And then the question was around how do you separate the wheat from the chaff? And so we take a industry first approach, right? And so we underwrite to industries that we think are attractive, that they're large and growing, large both in terms of total revenue and number of opportunities in the industry, growing. We want industries that are not in decline, that have opportunities, wind at your back, if you will, and also contain good business models. And so I think if you first filter on that, you narrow down to a subset of industries where you can stick your shovel and start searching. I think the follow-on was like, how do we run our search process? What we call operators in residence, so it's an incubated search. We put them on our platform, and roughly 80% of their time is focused on proprietary sourcing of deals. And so we generate a thesis around a specific industry or a niche within an industry, have access to private company databases, get those lists of companies. We then enhance the data with business owner names and email addresses and phone numbers. And then we do proprietary outreach to those business owners, describing who we are, what we're looking to do, and try to see whether or not there's a fit and enter into a conversation about a potential acquisition. That's about 80% of their time. And it's a lot of work, as you can imagine. Mm-hmm. About 20% of our time is spent on brokers and intermediaries. I think roughly half of the deals we've done have been through the broker and intermediary channel. I think more and more, anyone who's serious about selling their business is probably going to engage someone to help them in that process. And so we want to make sure that we have exposure to deal flow through brokers and intermediaries. And that's, naturally they're trying to create a process, create some competitive tension. But I think the fact that we're very much focused on succession, that's a bit of a differentiator from a lot of traditional financial buyers. And so it may start out as a process that feels like an auction, but I think that if we're differentiating on the value we bring in terms of our ability to transition the owner out over a relatively short period of time, and our long-term view and holding period, I think we can differentiate against more traditional financial buyers or strategic acquirers. And as a result, in our brokered and intermediary processes, no way to actually know this, but have been told that in every case we were not the highest headline number bidder, that we sort of won those deals on attributes.
Right, understood. Okay, almost the Warren Buffett style of acquisition. Just out of interest, well, which element do you find more difficult? Is it finding the right business or finding the right person out of business school to serve as an operator in residence?
I think they're both hard, but for different reasons. I think that the search is hard, but it's a numbers game. And I think if you just sort of apply focus and diligence and persistence to it, I think that you'll be able to uncover good opportunities. And I think that a lot of those factors are quantitative and knowable, right? Revenue quality, revenue history, margins, profitability, customer concentration, customer churn. Those kinds of things are quantifiable and knowable. And so you sort of can, finding those businesses with all of those qualities takes time and discipline, but at least when you're underwriting, there is a set of knowable factors that give you a lot of confidence, right?
Yeah, yeah,
With entrepreneur operators, there are attributes that we think are, if not predictive, at least indicative of success, being a leader in a small company, but they're largely qualitative and much harder to screen for. There is no score. And so we have a lot of interest from people in coming onto the platform and being leaders and entrepreneurs and finding a business to go run. And our job is to filter for what we think are the highest attribute folks that possess the the traits and characteristics that we think are indicative of success as a leader. And that's very hard.
do you have strong networks with the business schools whereby the business school themselves will step forward and say to you, you really ought to look at this guy, he's special?
We do have strong networks with the business schools. We're very involved with their search fund groups, their job listing boards. We get a lot of inbound interest from those business schools, and we sort of market the opportunity and who we are to those business schools. I don't think that they do any sort of pre-screening or selection or point us in the right direction with people. That's up to us.
Yeah.
I think that where we get better signal is through referral networks from either the search fund community or from our existing presidents and operators who have someone that they know in their past. Maybe they were a classmate,
Yeah.
section mate, business school, or they knew them professionally, and they know, they've sort of worked with them in some capacity and say, I think that this person has what it takes.
Okay. All right, let's move on and let's look at the business model itself. I've studied in great detail what I call serial acquirers and also programmatic acquirers. And for your benefit, let me just explain the way I use those terms. So for me, a serial acquirer is someone like Brad Jacobs, who within an industry effectively rolls up little companies in order to make a big, strong entity and to gain market share. A programmatic acquirer is someone who turns M&A into kind of an art form, almost like a Constellation Software or a Berkshire Hathaway, where they effectively collect a portfolio of completely disparate companies that all operate independently of one another, and they're not looking for synergies. So that's my distinction in those terms. But so I'd like to distinguish your search fund model from the modus operandi of some of the other programmatic acquirers like Constellation or Berkshire. So looking at their model, they prefer continuity. So they adopt a very hands-off approach. And I think they look for businesses where there's an existing succession plan, probably promotion from within, where the owner wants to step down, but there's a funding gap because those in internal promotions that need to happen for succession, those people don't necessarily have the capital to buy out the owner. And so in essence, Constellation come along with the capital, and they facilitate a change in ownership, not a change in management. So the management and the company continue as before. It's just the ownership that changes. But your model is different because you do change the ownership and the management. So you've got two potential points of failure there. Essentially, you're kind of speculating that the acquired business is good and the person that you insert to run that business will also succeed. And if either of those assumptions proves incorrect, the acquisition's in jeopardy. And just wondered, how you think about that in the context of the way the other companies I mentioned operate.
Yeah, I think that's a very fair characterization. Our model is certainly different than buy it and keep the team, right? But we've sort of said, kind of laid the context of the opportunity set where you've got a universe of founder-led businesses who are looking for succession. That typically in these small businesses, and we're talking, somewhere between 1.5 to 4 million of EBITDA, there isn't a huge bench of future CEOs. It's just the nature of small business, right? And so I view it as a risk and an opportunity, right? I think we're able to differentiate based on our model and find great businesses and prevail either in a proprietarily sourced format or through brokers and intermediaries without being the highest payer.
Yeah.
But it does introduce that secondary risk. I fundamentally believe in the idea that attributes trump experience over time. Over time is the important component there. But put another way, if you take a very high attribute person, smart and curious,
Driven,
hardworking, disciplined, grit, tenacity, perseverance, humble, honest, and with a strong will to be successful, they will learn the business over time. And that person, once they get up the experience curve, will outperform someone with sort of lower attributes. And so we're really looking for people that possess the attributes that can learn the business and then over time outperform what may have been, a different profile of an incumbent team.
Yeah, no, that makes sense. Okay, I'd like to pick up on something that you mentioned earlier, and it's another distinction between Kingsway and the likes of Constellation. So they generally intend to buy private companies and hold them forever, whereas at the moment, at least, you have an eye on an exit. So their model works on extracting cash from subsidiaries to fuel the flywheel of future acquisitions, becoming ever bigger and stronger as a group. But your model is more like I kind of hesitate to say, almost like a private equity type setup where you invest, you exit, and then you recycle the cash. Although before you mentioned that a lot of the search funds in the past have exited too early, and you're looking at perhaps extending the length of tenure of ownership. So I'm just wondering, how you're thinking about that in terms of the benefits of compounding.
Yeah, I think that I would challenge you that our view is that we're looking to exit, right? I mean, ultimately, an exit is just a capital allocation decision, right? Kind of
Mhm.
what's the risk-adjusted opportunity cost of the capital employed in the business. And while traditional search has had these sort of hardwired requirements to exit, our view is that for a great business, our ideal holding period is forever. Now that's kind of a trite saying, and lots of
Mhm.
people have said that, but ultimately it is what's the best and highest use of our capital deployed. And if we own a great business and we really understand it and it can continue to grow and compound value, beauty of our structure is that we're not forced to be able to sell it because we need to generate liquidities. And so we go into these investments with the idea that we won't want to own them for a very long time.
Okay. Okay. The next thing that I wanted to explore is the distinction between services and products. So again, in my analysis of multiple serial acquirers and programmatic acquirers, both in the US but also in Europe, particularly Scandinavia, where they're kind of prevalent, is that most of the programmatic acquirers prefer products over services. So they prefer mission critical product companies because they're sticky, they ensure recurring revenue, they may have intellectual property protections. And most importantly, they've got operating leverage. So they tend to avoid service companies because service companies, in order to scale them, require more people, which kind of undermines that operating leverage. You seem to be less focused in that regard because you've got vertical software businesses, which is clearly a product business, but you also have a plumbing business, which is a service-based company. So I'm just wondering if you're able to kind of articulate your thinking in selecting companies and the distinction between services and products in that decision-making process.
Yeah, I would say that, first of all, I think I agree with the characterization that, any sort of commoditized business is really hard, right? But I think that our filter isn't really product versus service. I think our filters are, is there an element of criticality to the product or service? Is the demand recurring or repeatable? And as a result, does the company have pricing power? We talked about some of the industry dynamics. Is it large and growing and fragmented? And do the businesses, demonstrate strong unit economics? And I think one of the key differentiators between product and service is our focus on low capital intensity. I mentioned that I bought a manufacturing business. It had significant capital intensity, so reinvestment in working capital, inventory, receivables,
Mhm.
some PP&E, and it had like a natural product life cycle, and so it was fairly like R&D intensive, and as a result, it was a very complex, complicated business and very hard. And so I think that service businesses generally have much lower capital intensity and less complexity. And to us, if you sort of take mission criticality plus repeatable revenue, plus strong margins, plus large and growing end markets, you get what we would describe as sort of enduringly high returns on tangible capital. And that's sort of that's shorthand for what we're focused on. And product businesses, I think, have higher capital intensity and operating profit does not translate into cash flow.
Understood. Okay. Interestingly, I had a conversation recently with the CEO of a Scandinavian acquisition company, and he said something which I'd never occurred to me before. I don't know whether you ever thought about it in this kind of context, but he was saying that there are some products which fall within operating expenditure of their client base. And so they can sell them to middle management, which is an easier sale. Whereas there are other products which are classified as capex, much larger expenditure, which require a board approval and they're much more difficult to sell. And so he was saying, when he first got involved, he didn't never distinguished between the two. But over the years, he's found that those kind of the OPEX bucket is a better bucket to be involved in. I just wonder whether you've ever noticed that yourself, or whether you make that distinction within Kingsway.
Yeah, absolutely. I think that, obviously criticality is important, but you want this, in terms of the repeatability of the revenue, you don't want every time that they buy the product or service to be like a new purchase decision. And so we're very focused on small thing into big thing, just a small line item on the P&L that doesn't need some sort of senior approval. And so the ideal business for us is small thing into big thing.
Okay. At the moment, you have, I believe, 7 platforms in development. You've got skilled trades, you've got IT managed services, accounting services, etc. What's your criteria for deciding when to roll up multiple businesses into a platform, kind of the Brad Jacobs type model, versus keeping them standalone as autonomous assets, which is more kind of the programmatic acquirer type model? And I think your subsidiaries fall into both buckets.
Yeah, I think that it's a bit of a hybrid in that we are programmatic acquirer in terms of the platforms. Some of those businesses themselves can then become more of what you describe as a serial acquirer. And so what would our criteria be? I think we sort of break the taxonomy out by first start with like underlying industry growth and opportunity for organic growth in that business. And some businesses, this organic growth is somewhat limited, like skilled trades is an example. There is hyper local businesses, geographically constrained just based on truck time and ability to get to your customer. And that organic growth is, if you're already sort of number 1 or 2 in that market, it's not a whole lot of additional opportunity for penetration. And so how are you going to grow those businesses? I think that M&A becomes like a natural, inorganic growth becomes a natural idea. But just buying more businesses for buying more businesses' sake isn't what we're focused on. There has to be like obviously like a natural reason why more businesses in a sort of serial acquirer campaign actually make the whole better. 1 + 1 is greater than 2. And so are there actual, it's a dirty word, I hate it, synergies, but are there benefits to having multiple businesses under a single platform? And in the case of plumbing, there are opportunities for synergies, obviously sort of back office, technology, around dispatching and fleet management and things like that, purchasing, and interestingly, like marketing and SEO optimization, and also talent and recruiting. And so I think that our approach would be, what are the levers for growth? And if organic growth is constrained, does an inorganic strategy make sense? Are there reasons why buying more businesses creates value, right? And so that's how we think about it on the front end.
Okay. The reason I asked the question is because, again, particularly in Scandinavia, companies like Lifco and Lagercrantz, who have been fantastic programmatic acquirers for decades, they tend to avoid synergies. You said it's a dirty word, and they see it exactly the same way. I mean, for them, they say that in order to extract synergies, you need to integrate acquired businesses, and that's the biggest risk of failure. They prefer to avoid that risk entirely, and so that they deliberately don't look for synergies at all. But it sounds as though if synergies present themselves, you're happy to take those.
Yeah, I would say at a maximum, it's integration light, right? I'm a big believer in the power of decentralization. I think you want, the decisions being made as close to the customer as possible. And, our structure is what we call hard form decentralization. Like, that's very important to us. Within skilled trades, as an example, those businesses still operate under their own brands in their local geographies. And we're just trying to bring best practices, technology, a little bit of purchasing power, recruiting power to those companies, but still letting them be operated, run, decisions made at the point of impact. And so, I think it's still very much in the power of decentralization mindset.
Yeah. Okay. No, I'm pleased that you mentioned decentralization, because that kind of acts as a nice segue into the next question I had for you. I wanted to discuss the Kingsway, the KSX Supervisory Board. So you have a small but very formidable team. that offers counsel to your operators in residence. But as you scale to 15, 20 or more operating companies in very diverse industries, I was just wondering how you're thinking about ensuring adequate oversight at that KSX supervisory board level. And in particular, for those listening who are probably unaware, your supervisory board includes Will Thorndike, who is the author of The Outsiders, a book which is critically acclaimed, and I'm sure everyone listening has read, and also Tom Joyce, the former CEO of Danaher and the architect of the legendary Danaher business system. So people like that just aren't easy to find. So how do you think about scaling that board up with talent like that?
Yeah, I think that it's a great question. I don't have like a perfect answer, except to say that our view isn't that we would scale that up. They're not in a governance and advisory or a governance and oversight role, right? It's really about best practice sharing, coaching, and development of young leaders. And so from an oversight and governance role, let's come back to just like the structural design of the system and the incentives. We've structured the compensation and incentives for each one of these operators in the best way we can to have them behave like owners, that they have the opportunity to become meaningful participants in the value that they create. We don't pay them, enormous salaries. It's actually pretty low relative to the opportunity set for people with these backgrounds. They do have an annual cash bonus component, but it's tied to the things we care about, sort of cash flow return on our invested capital. And so if we start there from just structuring incentives the right way, I think it takes a lot of the sort of oversight and governance questions off the table because we sort of naturally aligned to behave like owners and care about the things that we care about as well.
Okay.
So the advisory board really operates and functions as, coming all the way back to my comment about sort of craft investing, right? Artisan apprentice is to give these apprentices access to the artisans around key sort of leadership and operating principles and disciplines. We come together and workshop on those things, whether it's pricing or communications or talent and talent development. And so it really is more workshopy and not at all governance and oversight.
Oh, yeah. Okay. For the benefit of those listening, Will Thorndike, correct me if I'm wrong here, JT, I think he's been investing in search funds for decades, right? And he was quite excited by the prospect of having search funds within a listed entity, which is how he became involved with Kingsway in the first instance. Is that right?
Yeah, that's something that a lot of people maybe don't know about Will. He had an incredible career as a private equity investor, but got his start as an investor in search funds. And many of his first investments in his private equity firm were actually search fund investment. He was the first institutional investor in search funds. I think that his private equity firm sort of outgrew its ability to deploy capital in the traditional search fund model, but those are his roots. And he personally is probably, one of the most prolific investors in search funds over the last 30 years. So.
Right. And both Will and Tom Joyce are shareholders in Kingsway, right?
That's right.
Yeah.
And so coming back to the second point of your question about Will and his excitement about Kingsway, I mentioned that primary research about the returns to the next group of owners of a search fund business. He was the one that did that research. And so the idea of having a more permanent capital vehicle to own these businesses for a longer period of time was obviously very exciting to him because of the research that he had done on the power of the compounding over longer holding periods.
Very good.
You have two reportable segments. We've been discussing the Kingsway Search Accelerator, or KSX, as you refer to it, but there's also the extended warranty business. When people buy a high-value item, such as a car or an HVAC system, they buy an extended warranty with it, and Kingsway functions as a principal, underwriting and warehousing the risk associated with extended warranty contracts, much like an insurance company, although I guess some of that risk may be shared through the reinsurance market. Either way, the deferred revenue accounting rules create issues for investors in assessing the true economic performance of an extended warranty business, and this is particularly pronounced while the warranty business is in growth mode. For listeners not familiar with the issue, allow me to explain. Under GAAP accrual accounting rules, warranty premiums are recorded as deferred revenue, a balance sheet liability. And while those premiums are received up front, revenue is recognized gradually over the entire warranty period of perhaps several years. The full operating costs associated with capturing those premiums are recorded on the income statement immediately, but the revenue trickles through over time, which negatively impacts the appearance of earnings. And this gives the appearance, or can give during a growth phase, the appearance of poor operating performance, even though cash inflows are strong. So, JT, how should investors think about valuing this segment, given these accounting distortions?
Yeah, first I would point out that the corollary is also true, that GAAP accounting can overstate the earnings power of a business in a shrinking company. You're sort of earning out the revenue from previously sold contracts, even though you're not replacing them at the same rate. So anyway, just point that out as well. And everything you said is true. It does create distortions, and sort of you got to look at both the income statement and the balance sheet to get to the sort of true cash generative power of the business. Most people involved in extended warranty industry use a modified income statement to think about the earnings power of the business. There's a concept called modified cash earnings, or EBITDA. And what that does is essentially changes the way that the revenue is recognized. It continues to defer the portion of the revenue associated with future claims and earn that over the life of the contract, but accelerates and earns the revenue associated with the administration fee on the day that the contract is sold. And so it's a little bit of a hybrid between true cash accounting and GAAP full accrual accounting, and it's called modified cash. And so we do speak to that in our earnings calls about sort of trends we're seeing in modified cash as a better proxy for operating cash flow in those businesses. The SEC is pretty critical of non-GAAP measures, and particularly around revenue recognition. So it's hard for us to fully disclose that. But it is, I think for anyone who's trying to unpack it, you sort of first look at on the balance sheet. Well, you obviously take the income statement and then a calculation around changes in deferred revenue on the liability side, and then also on the asset side, changes in deferred acquisition costs. Some of the acquisition costs, commissions, and things would get deferred. So if you sort of net all of that out, you can get to a proxy for operating cash flow.
Right. Okay, got you. As far as I'm aware, the extended warranty segment also suffered from a recent spike in inflation, which meant that the cost of parts was higher than anticipated and hadn't been priced into premiums, which adversely impacted returns. And that wasn't peculiar to Kingsway. Most insurance companies were hit by the inflation headwind. Is that now behind Kingsway, and have the warranties now been properly repriced?
Yeah, it was actually more labor than parts, although obviously cars are becoming more sophisticated and sort of complex assemblies and things, and so there is parts inflation. But the big sort of pandemic related inflation spike was more around labor than parts. Frequency, very predictable, but severity based on parts and labor, more importantly, labor inflation spiked. And so yes, we look at our underwriting every year, or even more frequently than that in many cases, and reprice based on anticipated future claims, both frequency and severity, and pass those prices through on a regular basis. We also look at kind of performance on a very granular level, like in auto, for instance, make, model, mileage band, to know within that universe of risk how to effectively price a specific vehicle, for instance. So yeah, it's a kind of never-ending exercise to continue to reprice.
Okay. Being an insurance-like business, as the warranty business is it correct to think of the premiums received as float that can be deployed to enhance shareholder returns, Warren Buffett style?
Yeah, so we talked about modified cash accounting. A portion of the premiums are set aside in a claims reserve, and that claims reserve is invested. We get the investment income from those investments, and then we use that claim reserve to pay future claims. Our claims duration is typically somewhere around 2.5 to 3 years after the policy was sold, and so you get 2 to 3 years of investable float.
Okay. Okay, I'd like to turn our attention now to the net operating losses that I mentioned earlier. So you've inherited these net operating losses of your predecessors, which is a huge structural advantage because it means that you can generate up to, I think, $620 million in earnings or capital gains effectively tax-free, which is quite an enviable position to find yourself in. Charlie Fisher, until recently one of the members of your board, is quoted as saying that the net operating losses don't drive our investment decisions. At Kingsway, the Knowles serve shareholders and we don't do deals to keep the Knowles happy, which is quite a nice way of summing things up. But can you clarify how you balance that kind of way of thinking with the economic reality that the $620 million in Knowles is effectively an expiring asset?
Yeah, it's a wonderful asset that we sort of the beneficiaries of some hard times, 15 or 20 years ago. But it is a wasting asset. They will expire over time. Most or nearly all of those operating losses were created before the Tax Cut and Jobs Act, and so they have a finite life and will expire. About half of those operating losses that carry forwards expire for tax purposes in 2029 tax year. And so while it's true that we don't let the NOLs drive our primary decision making, we also recognize that it's a very valuable asset, real shareholder value, and we want to not let that asset expire unused.
Sure.
I think that it's fair to say that it's unlikely that we'll generate enough earnings growth to consume those NOLs before they retire or expire rather. And so I imagine that we would monetize some assets to use the NOLs against the capital gains.
Okay. So reading between the lines, if you can't exploit them before expiry against earnings, you're going to be looking against the capital gains you just mentioned, which implies that you're going to be looking at divesting some of your holding companies. And I'm wondering, of the two segments you have, you've got the KSX, the incubator, and you've also got the extended warranty business. The first thing that comes to mind is that there would probably be an arbitrage opportunity in exiting some of the extended warranty businesses, which would almost certainly command a mid-teens valuation multiple. And then that money could be redeployed into more search funds at probably a low to mid single digit multiple. Is that part of the plan?
Well, look, I think we're always evaluating the best use of our capital and how to redeploy it. And certainly the NOLs are an important component and input into that analysis. I'm not going to sort of pre-announce any sort of asset sales or any plans around that. I think that we have said publicly that our focus at Kingsway is fully on growing the KSX segment.
Mm-hmm.
And so you can probably reasonably infer what that might mean for us strategically.
Yeah. Okay. And just out of interest and curiosity, the extended warranty business obviously doesn't fall within your KSX segment, and KSX is your main focus, as you just explained. That extended warranty business, was that inherited from the prior iterations of Kingsway? How did those extended warranty businesses come to be?
Yeah, so just before I came to Kingsway, they had acquired two small warranty businesses.
This is part of the merchant bank.
Mm-hmm.
Right, got it.
And with the insurance background. And coincidentally, in addition to the search fund investing, I was doing some independent sponsor type acquisitions of small businesses. And I was very interested in and developed a thesis around extended warranty about the time that I met the then CEO of Kingsway, who was in my YPO group.
Right.
And I had a warranty business under LOI, and Larry Sletz, the former CEO of Kingsway, approached me and said, JT, rather than use your existing investors and that model to buy that business, why don't we, Kingsway, provide the capital and you come to Kingsway to build an extended warranty platform? So that's really what brought me to Kingsway initially, was to build the extended warranty segment.
Okay.
I didn't have a background in warranty, but I really liked the unit economics of those businesses, right? Diversified contractual prepaid revenue at high margins and negative working capital because of the float component. And so really wonderful unit economics, maybe a little bit more cyclical than I would ideally prefer, but wonderful unit economics. And, perhaps not coincidentally, one of the most successful search fund companies of all time was a product warranty business.
Right. Okay, interesting.
So they had already had a small foothold of iron in the fire, if you will, around warranty, and I came and built that from basically nearly nothing.
Okay, that explains it. Thank you for that. So moving on, we discussed earlier that Tom Joyce, who was the architect of the Danaher business system, is on your supervisory board and is also a shareholder in Kingsway. And the Kingsway has now developed its own version of the Danaher business system, which is branded the Kingsway business system. What I'm wondering is, how long does it typically take for a newly acquired business to fully adopt the KBS principles? And what are the early indicators that tell you KBS is taking hold versus meeting resistance?
It's a great question. I think the pace is entirely dependent on the maturity of the business when you acquire it,
Yeah.
right? And I think that the way that we have structured what we call the Kingsway Business System adoption is really, again, this crawl, walk, run framework. And
Mhm.
where you start depends on sort of the maturity of the business that you inherit. And so we just want to see natural progress along that onboarding path and adoption journey. For a new leader in a small company, it starts foundationally with learning the business by meeting with all of the employees and the customers and the suppliers and really understand quote to cash value stream.
Yeah.
Then sort of building a foundation of trust through authenticity, vulnerability, humility, making performance visible with a handful of strong KPIs, operational KPIs, customer focus, around quality, delivery, cost, kind of lead indicators, and then starting to build and upgrade your team and your pool of talent in order to first articulate a vision and then go execute against it. And so, some businesses have, good visibility into performance metrics and data and have mapped their core processes. Others are still operating on pen and paper and sort of gut feel and Kentucky windage. And so the pace of adoption doesn't change, but it really may be the starting point, right? And it really is a journey. And it I think generally will take, a couple of years or more to sort of adopt, implement, execute, install the chassis, and then have it operating effectively.
Right. Okay. Earlier we discussed the length of your holding, and it's likely to be extended given the work that Will Thorndike did in terms of discovering that longer holding periods may yield much healthier returns. And I'm thinking about the kind of proof of concept search fund within Kingsway, the one of the first acquisitions you made, PWSC, with Tyler Gordy as the operator in residence, which you exited after about 4.5 years with I think a 10 times cash return on investment, which is an awesome result. But that may be extended going forward based on Will Thorndike's work. So what I'm wondering is, how do you structure the operator in residence compensation to ensure long-term alignment? Because as I understand it from the Tyler Gordy case study, a large part of the incentive is an equity cash out on exit. So, what happens if the search fund company is growing rapidly and you decide to hold the business for a decade or two? How then do you keep the OIR aligned and incentivized, given that he maybe had his sights on a 5-year cash out, and now it's looking like a 20-year time horizon?
Yeah, there's a lot in that question. It's really an important question. It's all around alignment on holding period and time horizon. And I think a lot of ways to address that. Maybe just sort of talk about the exit and the catalyst for that, right? I think that generally we probably would have preferred to continue to own that business, but a confluence of several factors sort of catalyzed us to sell it, right? So first was sort of personal reasons for Tyler, family health issue, and he felt like he couldn't give 100% for a period of time while he was dealing with that. We also had fairly aggressive inbound interest in the business, so people willing to pay a very dear premium because of the team and the growth that he had been able to generate. And I think really importantly, we had an opportunity to redeploy that capital at a guaranteed very high rate of return by repurchasing some of our publicly traded debt at a very nice discount. So kind of a hardwired 20% IRR, with a sort of maybe small additional factor being proof of concept, put some points on the board to show both our board and our shareholders, the power of the model. So that was sort of a unique setup.
Right.
In terms of, how that translates into our current businesses and the way we approach it, kind of a longer holding period. I think we start with just alignment at the outset that our view is that we want to own these businesses for a very long time if they continue to generate our risk-adjusted returns on capital, right? And so the folks that come onto the platform come into it with that view that they want to be around and run one thing for 10 or 20 years, right?
So these are young guys, right? Straight out of business school, so they've got that career ahead of them.
And not everybody wants to do that. Some people want to run something for 5 years and put some points on the board and some money in their pocket and then go be a private equity investor or something. I don't know. But we're sort of self-selecting for people that want to own and operate one business for the rest of their career, ideally, right? Provided it continues to make sense to own it, right? And so start there and then structure the incentives around that. So you're right. Their participation is in the equity value creation. There's a couple of different ways that their equity vests. One of it, so time-based and performance-based. And we set some of those performance-based vesting provisions around either MOIC or an IRR, but with a mechanical calculation for IRR as opposed to like an actual liquidity requirement, so that they can actually sort of vest their ownership based on performance without having to sell the company. And then finally, like a unique thing about Kingsway, we haven't done it yet, but it is an opportunity or an option for us where, naturally a young person who's created some wealth in their equity will want to have that translate into some liquidity at some point, or like a perception of liquidity. People want to take some chips off the table. And I think kind of a unique thing about Kingsway and our structure is that we could exchange private company shares for public company shares and give people, at least Kingsway stock in their brokerage account so that they can see, perceived liquidity without actually selling the asset. I think that if someone wanted to swap, greater than 50% of their ownership, 40% of their ownership in the subsidiary, then it's probably, we should think about selling it because either they know something we don't, or they're not in it for the long haul, and we would probably sell it. But
alternatively, I suppose if the company is so successful that the capital value of that subsidiary has shot up considerably, then for the sake of argument, you may find it's one of your subsidiaries is worth $1 billion suddenly. Drawing down 50%, they're still going to have a pretty hefty stake left in the company. They're still going to have skin in the game.
Yeah, that's fair. Right. So I think it's case by case, but I think we, kind of go into it philosophically aligned on holding period, structure the incentives around not needing to have an actual exit for their equity to vest, and then a way for them to get liquidity without selling the business. Right?
Okay. When it comes to acquisitions, there's something which I think you've described as a J-curve effect following the acquisition. So, essentially you'll buy the company, you'll need to make an investment in the new business. But before the fruits of that investment are ready to be harvested, effectively the earnings metrics dip because you've incurred costs and you haven't yet seen the fruits of those investments flowing through, which kind of makes a letter J shape, hence the kind of J-curve effect. What I'm wondering is, do all companies take about the same time to pull out of that J-curve, or do you find it varies?
Again, it really depends on the maturity of the business that we acquire, but typically what we see in a founder-led business is that they have become a little more risk averse. The retiring founder has been running it for dividends lifestyle and less focused on reinvesting cash flows for growth. And so kind of the typical playbook that we would bring over time is to invest in process, technology, and people. And that is an OpEx load with the expectation that will reinvigorate growth, right? And so I think generally it depends on what you buy, but in almost every case, there's going to be some J curve, some exit more quickly, some it's less deep. But yeah, I think we go in with an expectation that while revenue may continue to grow, because of the OpEx load, you may have a little bit of underperformance over the first 12, 18, 24 months as you sort of professionalize the business.
And that's particularly relevant now because you've scaled up the number of acquisitions you're making and the size of acquisitions you're making. And so I'd imagine that a significant portion of your subsidiaries are still in the dip of that J-curve, and we're not yet seeing the full unit economics flowing through into Kingsway numbers.
Yeah, I would say that's fair. We've spoken about that on some of our earnings calls, that we're investing in these businesses with the expectation that will produce outsized results, and
right.
hopefully our shareholders have a long-term view and understand that and are focused on the future.
Right. The next question is kind of balance sheet focused. So you kind of got net debt. The last time I looked, it was around $68 million. And at the moment, the free cash flow is relatively modest, given the J curve effect and some of the other aspects we've spoken about. And I'm just wondering, how do you avoid becoming capital constrained? Given the pace of new acquisitions and elevated interest rates, how do you ensure adequate liquidity for growth without over leveraging the balance sheet? And is there a chance that you'll need to raise new equity capital?
Yeah, so net debt September 30th, I think, was around 61 million. About 15 million of that is at the holding company. The rest of it is subsidiary, typically bank debt that was taken on in support of those acquisitions. So non-recourse to the holding company, not cross-collateralized among the subsidiaries. And I think we're generally try to be very careful about leverage. We certainly finance each one of our acquisitions with a mix of operating company debt at relatively low leverage multiples, sort of 2.5 times,
Right.
and often some seller financing, and the balance from contributed equity from the holding company. And the idea being that as those businesses de-lever, you can either recap them and take capital up to the holding company to redeploy, or use the cash flow from those businesses to acquire new companies.
Oh, yeah. Okay.
Obviously, there's a point of flywheel that we are not yet at, where operating company cash flow after debt service is more than enough to fund the holding company infrastructure costs and deploy in your acquisition model. But we're making incredible progress in getting there. We have raised equity capital. We did a PIPE in 2025,
Yeah.
explicitly tied to that, our sort of multi-year acquisition strategy. And yeah, I think we do sort of want to balance the cash flow from our businesses and our deployment, and really focused on value per share. It's really important for us to drive intrinsic value per share, and we're very focused on the per share component. And so that may dictate pacing, but certainly would dictate how we think about raising additional capital if we do.
Right. I'm guessing with Will Thorndike on the advisory board, and with those kind of ambitions to grow, dividends are probably going to be the furthest thing from your mind, right? All the capital's all going to be reinvested.
Yeah, I think dividends are maybe not the most tax efficient way to return capital to shareholders. I think that we have in the past done share repurchases, not repeatable, but if we had capital and we thought repurchasing the shares was the best and highest use of that capital on a risk adjusted basis, I think that we would think about returning capital to shareholders that way.
Yeah. But yeah, okay. I mean, just for the avoidance of doubt, I'm a big fan of the Warren Buffett approach, avoiding dividends at all costs. Reinvestment comes first. So very, very much kind of aligned with your thinking. Out of interest, the market clearly doesn't understand your business model very well. So you're categorized as a consumer cyclical business in the auto and truck dealerships industry by Morningstar. And then FactSet has you misclassified as a multi-line insurer. And this obviously doesn't help in raising the profile of the business among investors. And to an extent, the company name is also a little misleading, because you're not really involved in financial services, despite being called Kingsway Financial Services. So I'm just wondering, what's your plan to educate the market and get proper analyst coverage, and to correct some of these mischaracterizations?
Yeah, well, you're absolutely right. We are poorly positioned for folks to really understand what it is that we do. And coming back to this crawl, walk, run concept, it was really not an area of focus at all for several years, as we were cleaning up the legacy Kingsway, launching this strategy, building some momentum and some traction. But over the last year or so, I think that we've done a pretty good job of starting to articulate who we are and bring shareholders to the story that understand what it is that we're building. And there's still a lot of work to do. I think that you will see over the next year a more concerted effort to clean up our classifications, communicate our story in a more concise and crisp way so that we're much easier for people to understand. I don't know that analyst coverage is per se the objective. I think what we want is to articulate our story in a way that allows people to understand what we're building, and in turn attract similarly long-term oriented shareholders to Kingsway that understand what we're doing, appreciate what we're doing, and want to be a part of. Analyst coverage, like generally there's a quid pro quo with analyst coverage. They expect capital markets activity. I hopefully don't anticipate capital markets activity. Doesn't mean that we wouldn't like more awareness of Kingsway. I think that we're just leery about short-termism in sort of analyst land, and so I think that you'll see a more concerted effort to tell our story in a clear, crisp, concise way and eliminate ambiguity or misclassification. And if analyst coverage comes with that, that's great. But I don't think that analyst coverage is what we're seeking per se.
I understand. Well, maybe this podcast is the first stepping stone in that process. Hopefully, it will help people understand exactly what you're doing and what the company is all about. So, what specific catalysts should investors watch for over the next 12 to 18 months? And where do you personally see Kingsway by the end of the decade?
That's a great question. I think we'll take it in two parts. I think that for us, obviously, pace of acquisitions, we've sort of set a goal of 3 to 5 acquisitions per year. I think that can scale as the operating cash flow to redeploy continues to grow. So pace of acquisition. We track what we call run rate EBITDA, which is the EBITDA of the businesses that we currently own, as if we have owned them for the last 12 months. So it's not technically run rate, it may be pro forma. I think tracking that relative to the share count to get to kind of run rate EBITDA per share, I think is a very important metric to track. And aspirationally, 5 to 10 years, we will have reached the point of flywheel and continue to increase the pace of acquisitions and grow the run rate EBITDA per share in a very significant way. My personal aspiration, this sounds a little corny, James, but I want to transform 50 lives. And by that, I mean support, nurture, help grow 50 amazing leaders who can transform their lives as incredible business operators and leaders, and hopefully have like life-changing financial success as a result. And so that's really what I get excited about. I work with incredibly talented people. I think we're unique in sort of micro cap, small cap businesses in terms of the quality of the talent of the people that are running these businesses. And if I can have a part in coaching, developing, nurturing, and making them their best version of themselves, and that translates into professional and financial success for them, that is my ultimate aspiration.
That's a very noble ambition. It kind of reminds me of an interview I saw with Jeff Bezos, where I think the interviewer asked him about the incredible wealth he's created for himself, being one of the richest men on the planet. And he said, forget about that. That's not important. What's important is how many lives I've changed. And he said, that's how I'd like to be measured. And it sounds as though you've got a similar ambition. So, very good. You own about 5% of the company, and insiders collectively own around 35%, I believe. And given that you've remolded Kingsway into the company it is today, and you're heavily invested in its success, is it your intention to maybe follow the Warren Buffett playbook and still be running this company into your 80s and 90s? Or do you think you'll probably hand the reins over to someone else at some point? And if so, how do you think about succession planning?
Yeah, look, I mean, touch wood, 80s or 90s, hope to make it that far. I don't know that, ultimately that's a board decision, right? They have a fiduciary responsibility to their shareholders. Hopefully I continue to earn the trust and support of the board for as long as I feel like I can contribute to the company. But succession is an important fiduciary responsibility of the board, right? We're a small company. We're a very small holding company. I don't have any designs on leaving anytime soon. And hopefully I can continue to be a good contributor to the company for as long as my sort of aspirations continue to be to run it. In terms of succession, I'll come back to the comment I made earlier. We are building an incredible group of young leaders in this company, and I think that succession naturally comes from growth and development from within. And so I think we're, by default, because of our model and the quality of the talent, there's this natural talent flywheel and succession talent engine that is being built.
Okay, makes sense. So, in closing, given that Kingsway doesn't screen very well at the moment for the reasons we've just discussed, but you're wondering what frustrates you most about the way that Kingsway is perceived by the market at the moment, and what message would you like to leave in the minds of listeners?
That's a great question with sort of myriad of answers. I think that generally, the mischaracterization of the company or the sort of attachment of Kingsway's legacy to the company. I run into that a lot. Oh, Kingsway, I heard about them. You're an insurance company, and so I think that what I want people to take away is that we have elements of a programmatic acquirer, decentralized operating philosophy, a collection of really wonderful businesses led by exceedingly talented people, and a very unique and proven strategy to continue to grow both organically and via acquisition with hopefully little or no additional capital required, and a very long-term view and an incredible tax asset to protect those cash flows. And I don't know that that is perfectly well understood because one, we're hard to find, two, we're hard to understand, and three, there's sort of the hangover of old Kingsway.
So, that's a wrap for today. JT, thank you so much for sparing so much of your time for this discussion. I've really enjoyed it. And as a shareholder of Kingsway myself, I'm really excited about what the future holds. So thank you again.
Well, James, thanks for having me. I really enjoyed it too, and I appreciate the support. It's a really enjoyable conversation.
Okay, have a great day, and we'll speak again soon.
Super.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.